Quint.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap for all the stocks that are buzzing in trade. I'm Darshan Mehta. But before we begin the show, Mahindra and Mahindra Financial came out with its numbers. They saw the net profit rise 87% compared to last year. Disbursement, however, saw a slowdown compared to last year as well as on a sequential basis. Shefali Malik spoke to Ramesh Iyer, the Vice Chairman and MD of M&M Financial, and began by asking him the factors behind the slow disbursements. Let's listen in.
If you kind of look at it in terms of lower disbursement in this quarter, is caused mainly by our conscious decision to go slow on the SME segment given the market condition overall, and therefore compared to last year in this quarter the disbursement of SME have been substantially lower. But on a vehicle segment, which is our main segment, we've actually have had a 10-12% growth. So that's what has caused really the dip in the disbursement for this quarter. But as otherwise, if you look at the overall year, we have had a 22% growth in disbursement, and the limitation of disbursement is mainly caused by our conscious decision to go slow in SME this quarter.
So why have you taken that decision? Is there some kind of a distress in terms of asset quality or maybe margin pressure as well?
No, so really that was a segment where we were supporting smaller NBFCs across different states, where we were also looking at certain possibility of using them for our extended administrative work like collections, etc. But they definitely, given the overall liquidity condition of the market, our belief is that some of these NBFCs could go slow in their own disbursement, and therefore the need for providing more money from our side did not arise. The demand wasn't there. So that's what the conscious decision was. It is not caused by at all due to any asset quality. The asset quality is extremely good. In fact, in those segments, the NPAs are nil. So it's not caused by asset quality, it's just the demand from that segment which went slow, and therefore the disbursement was low.
Okay, so it has been a very challenging time for the NBFC sector on the whole. So even though you have been on the better side, but in terms of margins, in terms of your ALM position, where do you stand at? And any sort of repayment pressure or the redemption pressure coming up in next few months?
No, so if you kind of recall our various discussions, even when this liquidity crisis opened up a couple of quarters back, we've always resorted to a very strong ALM match all the years. It's nothing to do with just this situation. Given that kind of a very strong practice, we have not had any pressure on the liquidity front, though as we raised money for our business, we had to pay a little higher price. But as far as availability was concerned, for a business model from a strong promoter background as ours, we did not have any problem whatsoever, nor do we see any going forward. We have an excellent match of ALM in every bucket of ours, and we have absolutely no problem, that I can confirm.
Sure, sir. If you allow me to sneak in one last question. Due to the auto slowdown, did you witness any sort of pressure in the tractor sales or on an overall basis as well due to the auto sector slowdown?
So clearly, if you look at it, the rural market has possibly contributed better than the urban market, and therefore, even though the overall growth of auto, etc., would be lower, but the contribution for rural has been better, which is where our presence is. Second is, we have not witnessed too much of competitive pressure for us in that market, which both of this has led to an increased market share. Third is, we are a very multi-product company with a deeper penetration, and that's the third benefit that we have got, mainly from a pre-owned vehicle, commercial vehicle, construction equipment segment, where we had a lower base. Fourth is a large customer base, which helps us get more customer from the villages. So ability to direct source business, about 18-20% of the business is direct sourced, has been the other advantage. Put this all together, I think we've been able to overcome the pressure of the market substantially well.
Okay, let's welcome our guests on the show. Joining us today are independent market expert Shahina Mukadam and Dharmesh Kant of IndiaNivesh Securities. Let's talk about what we want to talk about in today's discussion. We'll discuss Ultratech results. It's been a stellar run. It's up almost more than 10% in the last 2 days, and post the disappointing results by ACC, this came as a big surprise. So Ultratech we'll discuss in detail. We also discuss the aviation space and whether the jet crisis is any benefit to the peers or a sector is totally an avoid, because counters like SpiceJet and Indigo already have actually moved up. MRF is another counter. At least few months ago it was always in focus. Now it's seen a substantial correction from its 52-week high of over 80,000. It's now close to 50,000. We ask our analyst, is there many more downside on the stock or the sector as such? And finally, we're in the midst of the earnings season, and we ask our analyst which is one stock that they believe that will deliver strong results this time around. So let's start with the first stock, and that is Ultratech. It's clearly the stock of yesterday. It's clearly the stock of today. It's up 6.5% in today's trade, trading at record highs. Strong set of numbers, but is this the valuation that Ultratech deserves? And this comes on the back of a very surprising result that ACC came out. The ACC disappointed, and the counter was down 5%. So Ultratech, Dharmesh, what did you make of the numbers? 12% up post the move. Does it deserve such kind of a move?
See, the numbers has to be seen in the light of the synergies playing out of Binani Cement and JP. So what has happened is inorganic growth has been there in the volume of take rather than organic growth. So that is reflected in the numbers. Plus cheap limestone raw material is there, and they have been managed to do the operational efficiency. Plus they have already hedged first half year of raw material input like petcoke, diesel and petrol prices. So that will be there. So numbers were good, but I don't think the type of volume growth which was seen is going to sustain going forward for next couple of years. So one is the elections are due. Post elections, how the infra speed, the continuity of the speed has to be seen, which I suspect will not be so great, considering the fact that there's already fiscal deficit and fears like that looming on the macro front. Secondly, what I believe is the valuations are far too expensive now. Okay. So today run up may be there, maybe one more day of run up you can get, but then it will be sideways to a downside kind of a movement. So 50 plus kind of a P multiple for a company which will deliver say 12 to 15% kind of a CAGR on PAT is not warranted. ROEs are already there, and Binani, for them to break even, it will take some more time on a PBT level. So I think one should use this opportunity to get out of Ultratech, book profit and stay happy.
Okay, so it's basically surprising that you're getting an FMCG valuation for a commodity company. You'll have official coverage on it. So post the numbers. What have you told your clients? Have you told them to also start exiting?
Yes. In cement space, most of the companies we have told to we are neutral or exit mode. Barring Sri Cement and Ramco Cement. So those are two pockets which we still believe can deliver 5 to 10%.
Sri Cement and Ramco.
Ramco Cement.
Okay, I'll come to that in a while. Shahina, before I go to him again, what's your sense of first take of Ultratech and the numbers?
The numbers were very good. Okay, what I take away from here is that they have in a way succeeded in controlling the costs, and the EBITDA margins almost about 300 basis points higher was a very big positive. Volumes, in my view, it is possible that given the the consolidation that's taking place, they may be able to, maybe not at the same pace, but given the volumes that they have, they may be able to continue the at least double-digit volume growth going forward. So these two factors put together do make it a good long-term bet. I would totally agree with Dharmesh on the valuation part. I think the valuations are far stretched to an extent. If you really look at, let us see the current year. FY19, they've ended the year with an EV by EBITDA of almost about 18 times. And even if you factor in the best case scenario, that let us assume that they grow by 30% plus in terms of profitability, I think there also in terms of valuation, it is about 12 to 15 times EV by EBITDA, which does not make it cheap versus peers. On the other hand, if you look at it on an EV per ton basis, there also it's almost around $200, which is almost very much on the upper side compared to any of the other peers in the overall segment. So to that extent, I think it is expensive, and at the same time, what I feel is that they still have the scope of reducing debt, improving overall performance in terms of EBITDA. Given the fact that the acquisitions that they have made, there is a scope for improvement in terms of operational efficiency. So it is possible that over a long-term period you may get a return, but in the next 1 odd year, I don't see a more than 5% higher return.
How should someone look into it? Because in 2 consecutive days you had ACC, which disappointed and didn't give the best of the commentary, and then you have Ultratech, which came out with a strong set of numbers and gave a strong commentary. How should one look at the cement scenario at this point of time?
On a personal basis, I would take the contrarian call. I think everything that is good is factored more or less in the next for the next 1 year, factored into the price of Ultratech. At the same time, ACC, while they have delivered below analyst expectation numbers. It is not to say that they didn't deliver good numbers.
Sure.
So to that extent, I would sort of discount what analysts say, and I personally have bought into the dip that we saw, and what I believe is that in terms of valuation, ACC and Gujarat Ambuja are much better placed, as well as you have growth that will come in because of the capacities that are going on stream. So I would bet on a contrarian play, while if one is a long-term investor and one is holding Ultratech, I wouldn't tell them to sell and get out if your portfolio factors that in. But otherwise, if one is looking at fresh investments, I think one should look at other stocks which are available at more reasonable valuations for a better return.
Okay.
I'm not saying there won't be a return. I still think that 4,800 over the next 1 year for Ultratech is doable. So I don't see a downside. I'm overall very positive on the cement space, but I wouldn't be a buyer at current levels in Ultratech.
Okay, Dharmesh, before I come to ask you why you like Shree Cement and Ramco Cements, how should one read into the contradictory results that came out? Because both are national level players, pan-India players.
Right.
One disappointed, as she said, they disappointed the analyst estimates, not on their own. But how should one look at the cement scenario now?
See, on the overall console level, if you look at the cement industry, so it's a single-digit kind of a volume growth, and it will dip down going forward. So the volume came in Ultratech because of the synergies of mergers and acquisitions. At console level volume growth we are seeing. Standalone, it is not there so great. So the commentary which they have guided is they are discounting the benefits of JP and Binani coming into the play, rather than organic growth coming into the cement space. So on the, I think I don't see a big volume growth in cement space in next 1 year.
Okay, the 2 stocks that you like, why do you like Shree and Ramco?
Because of the geographical location.
Okay.
So central India, northern India and east India are the areas where most of the road construction activity is going on. It's likely to go on further. If you look at the projects, either it is 2 to 4 laning or 4 to 6 laning, 8 laning. These are the areas, pockets of development, and they have their factory locations in these geographical areas. So
Ramco has a lot in south also.
But majorly now they are focusing on the East India side after the acquisition. So what we think is that will come into the play, and valuation wise there's a comfort. So Ramco almost from a mid cap kind of a space.
Okay, so that's the view that's coming in. I think Ultratech, obviously after the big move, the view somehow seems to be positive overall, but at valuations I think seems to be the biggest concern. Both of our guests do believe that there are other stocks in this space which offer a better return potential rather than Ultratech. Dharmesh himself says that they have recommended their clients to start trimming positions in Ultratech, given the fact that valuations seem to be extremely sky high. The other interesting sector we want to talk about is the aviation space. Now, ever since Jet shut down operations, both SpiceJet and Interglobe Aviation have done well. Both of them have rallied, but will this rally continue? What's the scene in the aviation sector? Will any kind of white knight, are SpiceJet and Interglobe stock prices running the risk of a white knight coming over and taking over Jet Airways. So that's something that we'll discuss. Shahina, how should one look at everything's out in the open right now? Jet is shut. There are 2 listed entities. There are a couple of unlisted entities that are also flying. How should one play the aviation space? Is the move totally built into the price at this point of time, the worst case scenario, or should someone put in money in the aviation sector now?
I have a total avoid on the sector at current levels. One is because while yes, totally Spice and Indigo are benefiting from the problems of Jet. So to that extent, yeah, the stock prices have already given you that 50% upside from the time the problem started. I think at current levels, it's the best is more or less factored in, because if you really look at history, the moment you have crude prices moving up, the aviation fuel prices follow tandem, and the companies, these airlines have shown that they are not able to effectively meet or improve or maintain their profitability and margins when the crude prices are higher. So if we see now, it seems like we've seen the bottom of the crude prices and they're just inching higher, if at all. I don't believe that going forward they would be able to improve margins from where we have seen them doing as of now. Secondly, what I believe is that with Jet prices, the stock price having corrected to almost 160, 165 currently, which if you remember is close to the 150 level when the whole issue started for Jet. Okay, this is the fair valuation for 150. There could be buyers, okay, or with deep pockets, or there could be somebody increasing stake. I think that potential has now sort of come up. Yes, it is definitely there that whoever comes in will have to bear something like 15 to 20,000 crores of sort of inflow of funds. That is true, but then it is in all possibility that there may be some white knight who would step in. So that is a risk, and also so it is a question of 2 months, 6 months. So if you're a trader, I'm not really I don't have an opinion, because that you follow the crude and crude price and you trade. But if you're an investor, that overhang remains. And also if you see in this troubled times, you have had newer airlines which are becoming pretty aggressive, and they are giving you options. So first time triers who would probably not have flown them if you had Jet there would start trying them out. And I think once you have that comfort level, the competition will intensify. So even when Jet comes in, which I think it will in some format or the other, so to that extent, or the capacity will increase for the other airlines which they're talking. So I think airlines is a play between capacity, and I think the capacity is going to go up over a period of time. So
would you bet on someone buying Jet Airways for investment?
It is too risky. I'm risk averse actually.
Okay.
So I personally wouldn't recommend anybody to buy Jet Airways, but I think it may give you a decent return. It's a high risk, high return. Very high risk, but it may give you that better return than the rest of the airlines if you're holding it for a year. But I personally wouldn't take that risk.
Okay, Dharmesh, what's your sense? I believe you all have coverage on the aviation sector as such. Post this entire scenario, what has happened with Jet going down, how are you looking at this sector differently? Have you told your clients to start accumulating more of SpiceJet, Indigo, or what's the sense that you have?
See, first of all, price-wise, they are now overly priced. The type of valuation they are trading at. I will do a simple math for you for the aviation sector. So around 50 to 60% is their operating cost, which excludes fuel and power expenses. Fuel and power expenses around $45 to $50 when the crude oil is there. It amounts to 25% of the operating cost. So if put together, if companies like Indigo or has 75 to 76% of the operating cost, SpiceJet, Jet Airways had a higher operating cost, 80-85%. If fuel prices go up by 50%, so 50 becomes a 75 Brent, which it is right now. So then this expense of 25% goes to 37.5%.
Okay.
So you hardly have any margin to suffice your interest and depreciation or taxation. So taxation none of them have because of their carry forward of losses. So the sensitivity is very high. Look at Q2 numbers. Everybody reported loss. In spite of Q4 going bumper for them, SpiceJet and Indigo, they would hardly been able to scrape through to post a EPS, positive EPS for the full year FY19. So my own sense is that airlines are more of a cyclical play. If Brent and you're forced to 45, 30, buy them, play them as a trade, and get out. Because see, what has happened is whatever jet the business has, whatever jet has lost as a business will be acquired by Spice and Indigo, and other airlines, which they have started doing. So jet has now is an empty vessel. But this acquisition, either it is going to come at a cost of equity, or that is a big question to be answered. Even if it comes on the equity and cash flows which these companies are having, like Indigo has a very good cash balance in the balance sheet. Then too, 75 to 80% is locked at $50 of crude oil prices. At 75 Brent, they will be making only 4 or 5% of operating profit. So sensitivity is too high. $5-10 more from here, 80. They will again report loss in spite of all this business coming to play. So this is an aberration quarter which we will see, Q4 and maybe Q1 of FY20. Post that, once the things rationalize, the entire business is again distributed against the existing player. It will be business back to square one.
What about jet? Should someone buy jet for the long term?
What is there in jet? Tell me.
I don't know. I'm asking you. That's what I'm saying.
So there is nothing left in jet.
No,
they
but
they don't have planes. Zero plane with them. The airport slots which they were having is already being given to others. Air India, SpiceJet, Indigo, they are all taking. So that is also lost. So if somebody, and at 160, I mean when this SBI was offered shares, there was doubling of equity when the stock prices went up. So I was bewildered, because this is the first, if you look at the entire world history, there has not been a single company which doubled the equity by issuing shares, and the price also went up of the stock price. So valuation, you doubled your valuation at the same level of debt, cash flows flowing, now the business is completely shut. So why 160, even 165, why? To my mind, it should be zero.
Okay.
So if somebody comes and acquire at a very cheap valuation, say 30-40 rupees of a stock price, somebody takes over Jet Airways, then they have to rebuild the entire business. First of thing, 12,000 crore of debt will be there. Then they have to hire plane on lease. So all this financing will be big sum. Plus airport, the slots which have already been allotted, you have to get back them. So it's a start of a fresh business with a heavy debt. So I don't know why.
Okay, so that's the view that's coming in on aviation at this point of time. The other sector which somehow is feeling the stress is the tyre sector, and one of the biggest stocks there is MRF has corrected all the way from 80,000 close to 50,000 right now, 55,000 in fact. Dharmesh, your sense on MRF in the tyre space?
See, tyre space will see a slowdown this year, because there is a slowdown in the automobile industry as such. And thankfully rubber prices have not moved up to that extent, so that hurt is not there. Fuel prices have went up, which again adds to the cost of tyre manufacturing. So that margin, we have seen deceleration in the margin. I mean, MRF lost 300 basis points on the operating level as far as margins are concerned, so that will continue to be there. I think now the price is fairly, so the downside is limited. At the same time, upside is also limited. So OEM will not see any traction as far as volume growth is concerned. Replacement segment may see some traction, thanks to the government of India imposing anti-dumping duty. So that protection is there. But MRF is more in the OEM segment rather than in a replacement segment. So replacement would be taken over by JK Tyres. So we firmly believe that companies like JK Tyre, where the tyre cost is 20% cheaper than MRF, or the high niche end players of this peer group, so they would be losing business to them. So to my mind, it's better avoid rather than any buy.
Okay, Shahina, your sense on MRF?
Yeah, I also have a avoid neutral call on MRF. I think what we saw in the last couple of quarters is likely to continue on for some more time. While I agree that natural rubber prices have been sort of flat over a year YOY basis, but the costs have somehow risen, and we've seen last quarter also EBITDA margins were down by almost about 500 basis points. I see no improvement in the overall margins, and I see that continue to be a problem. I think the prices have corrected to more or less fair levels, so I don't see much downside also from here. I think 55,000, 60,000 is fair price for for a stock like MRF, considering that despite everything, the valuations are not expensive. If you look at an EV by EBITDA basis, it's about 10 times. EV by turnover going forward is about just a single 1 time. So given the brand and given the overall premium it commands, I don't see that's expensive, but I think the problems will will continue both on the volume top front also, I don't see them growing by more than 5-6% in terms of top line, and profits are being impacted. So to that extent, I think it's going to be a very dull year for an investor in MRF, and the correction as of today now factors in the negatives, but we'd see a slow, steady up move over a period of time.
So I think it's more like a neutral view that's coming in on MRF, not too much upside, but potentially the downside factors in the current valuation, don't see too much downside also. And we're in the midst of the earnings season, so Shahina, one stock that you're betting on that will provide very good financials this time around, which could be the turnaround stock?
Actually, something like Ambuja Cement, already the numbers are there. We already have them, and I think this is a good play on the overall cement space, because if you look at the valuations, in my view, where I believe that while South has done better in terms of cement prices, I think the prices in North and East will catch up, West also, and I see a price increase of almost about 5 to 8% over the next 2 quarters, at least 1 to 2 quarters. I believe Ambuja is well poised to benefit from that upside. In terms of valuation, because I'm positive on the overall cement space, I think in terms of valuation it is pretty attractive. If you see, it is ended the year with almost about 12 times EV by EBITDA, and if you factor in a 20% or 25% growth over the next 1 year, it's available at between 8 to 10 times, which I don't think is expensive, and also an EV per ton basis, it's attractive. So overall, I think in terms of valuation, I would prefer Ambuja Cements or its parent, which I personally also hold, and then some of the other cement stocks also. In terms of potential for growth and performance over the next 1 year, I prefer the overall space and this particular group.
Okay, so Ambuja and cement space is something that Shahina is betting on. What are you betting on? Which stocks you believe that could provide fabulous results this time?
So what I have strategically thought of is to go for a stock which is insulated from election results or macro headwinds. So ONGC seems to be highly undervalued at current market price. The company has reported a fabulous set of numbers. Q3 was very strong. In fact, 17 rupees EPS they posted for 9 months, whereas last year the entire year was 17 rupees kind of EPS. I am expecting 23 rupees kind of an EPS for FY19 for ONGC. Going forward, since this quarter is an election quarter, so in election times the mobility increases, so volume offtake is more there. Brent has $70-75 is again very lucrative for ONGC, though the volume has fallen for 6-7%, but because of higher realization they have suited up around 14% kind of a growth on the top line, which directly translates to bottom line of ONGC. It's available at around 6.5 times FY20 earnings estimate on the PE multiple basis. Dividend yield is more than 4.5%, ROE is 14%. And their triple R is always more than 2P, around 1.4 times. So whatever they are producing, they are discovering more than that. And the costs have come down because the rigs are now available at a cheaper cost to them for new explorations. So all these are benefiting ONGC well, plus synergies of HPCL will play out in the long term. So refining margins, once it becomes favorable, then you will again see that translating into the bottom line of ONGC. So I do think that given the current scenario and the way this stock has underperformed the entire market, this is a time to have a look at it with very high margin of safety. And my 1 year target for ONGC is around 190 195 price. But if one becomes aggressive, it may be 230.
Okay, so that's the view that's coming in. The two stocks probably you have to watch out for the fourth quarter, ONGC and Ambuja Cement. But with that, it's a wrap on this edition of Hot Money. Many thanks to all of my guests for coming in. Shahina, thank you so much for coming in. Thank you so much, Dharmesh, for coming in. Ask BQ comes up next. Stay tuned to Bloomberg.